As of now, the estate tax exemption is set to drop by half in 2026. It's going from $13.61 million per person as of 2025 into around $7 million per person in 2026. And you might not think that that's a big deal because most people don't have that much, but it's going to impact a lot more people that aren't expecting it. Here's why. Since 2017, the estate tax hasn't been a really big issue. I get a lot of questions about it, a lot of questions about what kind of taxes are my beneficiaries going to pay? Will they have inheritance tax? Do I have a taxable estate? And since 2017, that's not really been that big of an issue for most people. As I mentioned, right now, the estate tax exemption for a single person is $13.61 million, and you can double that for a married couple. So most people aren't pushing $27 million taxable estates. But if that's cut in half, now we're looking at $7 million per person, $14 million for a couple. And again, that's still a pretty sizable amount. But what the issue isn't today, for many, many folks, and I work with mostly retirees, it's not that they're going to have an issue today, but instead it's an issue that for the person that has $3 to $4 million right now, and I'm talking taxable investment accounts, I'm talking real estate, I'm talking their actual home, and then add in any retirement accounts. When you look at the compounding of that, compound growth of those assets over the next 10 to 15 years, all of a sudden it's very possible to see people being impacted by it. And I ran the numbers, and you can see them somewhere on the screen right now. But I ran the numbers with a pretty average person, someone that would probably consider themselves comfortable. That's the term I hear most often. But they would not consider themselves rich. They have about $2 million in their IRA. They have $1 million in their taxable account, and they have a house or property that's worth about $1 million as well. So all in all, as of today, they have a $4 million estate. They're 62, and they're in good health, so they can likely live for another, call it 10, 15, 20 plus years. What happens and when it becomes a problem is when their estate keeps growing, because the market grows, on average 7 to 8% per year. When you look at real estate, home prices, those on average are about 3% per year. And when you look at it in that perspective, all of a sudden by the time that they're 74, they have a taxable estate. And this is for a single person. I'm not running the math right now for a married couple, but just know that it's something that can be very detrimental. When you've worked hard, you've saved well, you've done all the right things, and then you find out because you did all those right things, now you're going to have a 40% tax on any estate that's above that estate tax exemption. For the person I just mentioned, if they live till 90 and pass away when they're 90, they would actually be paying almost $6.5 million just in estate taxes. That's a really big deal because they would have a taxable estate of about $28 million. And that's just using straight line growth because I'm not really getting into a Monte Carlo simulation here. But straight line numbers, it shows you that this actually could impact what many people that would consider themselves middle class or upper middle class. It's not just billionaires. So I'm going to show you a couple ways that you can get ahead of this and things that you can do in the next year to begin planning ahead. Frankly, most of the techniques you would use for lowering your taxable estate, they're beyond YouTube. I can explain them, I can go into details, but they're not techniques, they're not strategies that you will do on your own. Typically, they're going to require a really good estate planning attorney who's well-versed in taxable estates. And over the next few years, we're going to see a lot more attorneys that dive into that as a specialty. But there are a couple things that you can begin to do now. And the first is review your estate plan. And this does go back to the attorney, but because of the changes, especially, I've been telling my clients for a while, by next summer, we should have a pretty decent idea about where things stand. We'll know who has Congress, we'll know who is in the presidency, and we should have a pretty good idea about knowing if the cuts will be, if the 2017 Tax and Cuts and Jobs Act will be extended into 2026 and beyond. If it's extended, all this doesn't matter. It's going to be okay. But if it's not, that's when the real planning becomes much more important. So get with your attorney. They should be able to work with you to build a plan that protects you financially now, but also protects you in the future by lowering your overall taxable estate. Some of the things you can be doing, though, are one of the biggest things is gifting. And what I mean by this is you have an annual gift amount that you can give, and there are no taxes due to you or the person you give it to. Right now, it's $18,000 per person. And what you can do with that is you can make a gift to your kid. You can make a gift to your grandkid. Anything below that $18,000 doesn't have to be filed on the gift tax return, typically. There are some exceptions, but mostly. So another thing you can do is you can do what's called gift splitting. And you can see in the picture here that gift splitting is a way that if you're married and say your kid's married and you want to give even more than that $18,000, you and your spouse can each give $18,000 to your kid, and then you can also each give $18,000 to your kid's spouse. You can even do it all on the same check, and you just actually split that gift on your gift tax return, which is IRS 709. And for tax purposes, this means that each of you made 4 individual gifts, and they were each of the exact exclusion. Because of that, again, no taxes, and it doesn't get into your lifetime credit, lifetime estate tax exemption or unified credit. So it's a pretty simple way that if you're already financially free, you have more money than you think you're going to need. And this goes also back to working with your financial planner to know how much do you need to be financially independent and not have to worry. But if you have more money than you need right now, you can go ahead and give some of those gifts while you're alive, and frankly, while you're able to see the value, see your kids enjoy that money, help them out when, if just for round numbers, if someone's 65 or 70, their kid's probably in their 30s, maybe pushing 40, somewhere in that range. And that money is going to make a big difference in their life. And so not only can you help them out in a time when they might need it more, you're also able to help yourself. And so it's a win-win there. I think we always push money and gifting to the end of our lives and inheritances, but I think there's a real value to pushing that forward and helping people when they can use it more versus when someone's 55 or 60 and they receive an inheritance and then they've already worked their entire life, they already have their savings, and it doesn't really make as much of a difference. So gifting is a big deal. Also charitable giving. If you're gifting charitably, that also reduces the size of your taxable estate. There are a lot of different ways you can do this, whether that is a charitable bequest. One of the best things you can do is if you have both taxable money and non-taxable money, so an IRA and a taxable account, for instance, direct that IRA to charity or a part of that IRA to charity and leave the taxable amount to your kids or whatever beneficiary you want. And the reason why you would do this is when the charity receives the IRA, they don't ever pay taxes on it. They can take the pre-tax money that was already in your IRA or 401k, and they can use it just like, a dollar is a dollar. Whereas for your kids, if they receive your IRA, they're going to have to take required minimum distributions from that account. They're going to have to take out a certain amount every year, just like you do from your IRA. And then they're going to have to pay taxes, income taxes on it. And what I see is, again, going back to if someone receives a beneficial IRA at age 55, 60, they're typically in their peak earnings years. So that actually pushes them, it can often push them into a higher tax bracket and have unintended consequences. Whereas if you leave the IRA to the charity, again, they get the full benefit, your kids receive the taxable account, and then they're going to get a step up on the basis. So instead of, even if you had a ton of capital gains in that account, they're going to get a step up. And so their basis is whatever it was on the day you passed away. And if they sell it, they only have to pay taxes on the gains from the day you passed away to the day they sold it. So it's also going to minimize taxes there. So it's a lot more efficient way to pass gains on. And then finally, there are other techniques like grant and retained annuity trusts, spousal lifetime access trusts, intentionally defective grantor trusts. There are a lot of different options out there, but honestly, those are really really in-depth tools that they're beyond the scope of this. I'll make some more videos later explaining them because they're good to know about, but it's more so know about them, have an idea of how they work, but then go work with a professional that does that every day so that you can get the help you need to get them put in place. But that's about it for today. Hit the like button, hit the subscribe, and drop any questions you have in the comments.